Did you know that 100 basis points or 1% decline in interest rates can lead to a 37% increase in the value of some bonds? Today I'm sharing 3 trading strategies that could help you take advantage of falling rates. As you may have seen, Jerome Powell and the Federal Reserve have begun to lower interest rates and have stated that they will continue lowering them in the future. When interest rates fall, existing bonds with higher coupons become more valuable. It's like owning a house in a neighborhood where property values are rising. Your asset becomes worth more without you doing a thing. Alright, so let's get into it. In a declining interest rate environment, bonds behave quite differently than most other investments. When interest rates drop, the prices of existing bonds go up. That's because new bonds being issued are paying less interest, making older bonds with higher coupon rates more attractive. This opens up some powerful opportunities for investors, especially if you know where to look. First, why invest during a declining rate environment? Simply put, bonds become more valuable. You can lock in higher yields by buying bonds before rates fall even further, and you also benefit from the price appreciation of bonds you already hold. Think of it like locking in a deal before prices go up, but it's not quite that simple. There are risks, and we'll get into that in a little bit. Let's break this down with a real-world example. As of this recording, the 30-year Treasury bond, which has a 4.25% coupon due February 15th, 2054, and is priced at $99.10, which is a yield of 4.3%. If interest rates fall, and in a year the yield falls by 100 basis points or 1%, to 3.3%, and it wasn't that long ago that yields were there, the price would go up to $117.32, which would be an increase in value of approximately 18.3%. That's the kind of opportunity we're talking about. We'll have some more examples with even higher returns later in the video, but remember, with those higher possible returns comes greater risk, so get ready. However, let's clear something up. A declining rate environment doesn't necessarily mean that all rates are declining. Just because the Federal Reserve is lowering its overnight rate doesn't necessarily mean that the 30-year Treasury is moving lower, or that municipal bonds or corporate bonds are moving lower, or that mortgage rates are always declining. All of these rates move independent of the rate set by any organization, whether it's the Fed, the European Central Bank, the Chinese government, whoever. The reality is that the supply and demand for each specific instrument, treasuries, munis, corporates, commercial paper, whatever, is what determines whether rates are going up or going down on that specific instrument. We saw this recently as the Federal Reserve cut their rate and the long end of the Treasury market responded a couple of weeks later to economic data it did not like by pushing longer rates up by more than 35 basis points. So we saw the 10-year Treasury move from a yield of a 3.65 all the way back up behind 4%. That's a big move in what everyone is calling a declining rate environment, and it's not a move in the direction that people are expecting. Now that we're in a declining rate environment, what are some things we can do and should be considered doing? Strategy 1 is something we've discussed on this channel before, and that's laddering bonds. I won't go into a ton of detail here, but I'll put a card on the screen so you can dive into that deeper if you want. Imagine it like this. Instead of putting all your eggs in one basket, you buy bonds that mature at different times. As each bond matures, you can reinvest at the current rates. Whether those rates are still falling or eventually rising again, this keeps you flexible and ensures you're always collecting interest while protecting against any sudden rate changes. It also allows you to have cash available to capture some of the higher interest rates when they're available, and it doesn't leave you investing everything when yields are at their lowest. Strategy 2. Now, if you're looking for higher returns while still maintaining stability, and your intention isn't to maximize the capture of capital gains from a possible bond price run-up, but you want to make sure you're maximizing your income and cash flow, even in the face of these expected lower interest rates, you can look into investment-grade corporate bonds. When rates decline, corporate bonds often see their prices rise as companies can borrow more cheaply and service their debt more easily. However, because they're tied to the individual company's ability to make regular interest and principal payments, you may not see a basis point for basis point move with treasuries of the same maturity. But remember, You want to stick with high quality companies to reduce your risk. Here's a little double secret tip you won't get on other YouTube channels. Diversify this strategy a little by incorporating some taxable municipal bonds if you're buying in a tax-deferred account like an IRA, or buy tax-exempt bonds if you're buying in your typical brokerage account. Municipals offer solid returns with very low default rates. Now let's talk about my favorite bond for maximizing gains in a declining rate environment. Treasury Strips. Strips are treasury bonds that have been separated into their principal and interest components. Because they don't make regular interest payments, they have the highest duration of any treasury security. This means they offer the most potential price appreciation when rates fall. A lot of folks like to run this strategy using the 30-year strip. If purchased today, the 30-year strip, which would mature in February of 2054, that bond would cost you $300 per $1,000 face value. This is a yield, if held to maturity, of 4.166%. But if in 1 year the interest on that bond goes down by 100 basis points or 1% to 3.166%, the price would increase to $413 per $1,000 of face value. That's an increase of 37.6%. That's significantly more than the 30-year Treasury bond example I gave you at the beginning of the video. That's a great return if you're right about where interest rates are headed. Personally, I approach this strategy a little differently. Instead of buying the longest maturity, the 30-year, I look for the peak of the strip yield curve, meaning I look for the highest yield. As of the taping of this video, the 20-year strip, due August 15th of 2044, is yielding 4.607% and costs $404.85 per $1,000 of face value. That's almost 50 basis points higher than the yield on the 30-year example I just gave you. If in 1 year, the interest rate on the bond falls by 100 basis points or 1% to 3.607%, the price will move up to $509.67, which is a return of 25.9%. I like the 20-year as a more defensive play. If I'm wrong and interest rates don't decline sharply, worst case, I'm in a better place versus the 30-year strip because I'm going to get 4.6% and I don't have to wait 30 years to get it. Also, in 10 years, if interest rates haven't moved much, my 20-year bond is now a 10-year strip. And if we look at where the 10-year strip is today, it's priced at 4.166% and costs $659 per $1,000. Which means if I sell it there in 10 years, that's an annual return of around 6.25%, which isn't bad for something as safe as strips. Meanwhile, in 10 years, my 30-year bond will now be a 20-year bond, the higher yield we mentioned earlier of 4.607%, priced at $404.85, which is actually an average annual return of 3.5%, a substantially lower return than that of the 20-year we bought and held for the same time period. I hope that wasn't too confusing. I know it was a lot of numbers flying at you. The key takeaway is, if you're willing to take on the big risk, you have the potential of making a really exciting return, that 37% I mentioned. However, if you're willing to give up some of that possible 37% and take 26%, you've got a much better defensive play if interest rates don't quite go your way. Some of you might be interested in locking in something like that 6.25% over 10 years instead, and that wouldn't be a terrible play either. It's all up to your individual investment goal. Another key takeaway from these two examples, as well as the Treasury bond example I gave you at the beginning, the strips will not pay you any interest payments, whether you hold it for 1 year or 10 years, 20 years, or 30 years. Where the 30-year bond example I gave at the start of the video will pay you $21.25 every 6 months for every $1,000 of face value you buy. So if you buy 25 bonds for $25,000 worth, you'll receive $531.25 every 6 months, and that interest will be exempt from your state taxes. Back in the early 1980s, under Fed Chairman Paul Volcker, interest rates hit an astronomical 15%. Smart bond investors bought 30-year treasuries, then saw their investments triple in value over the next decades as rates declined. While that exact scenario won't repeat, it illustrates the power of positioning ahead of rate decline. After 30 years of trading bonds, here's one of the most valuable lessons I've learned. The The best time to extend your maturity dates is when everyone else is fearful of doing so. Right now, many investors are waiting for rates to peak before buying longer-term bonds. That's exactly why current opportunities exist. However, I'm not going all in on the long end right now because it feels like the long end has gotten a little ahead of itself. We saw a major pullback in bonds a couple of weeks ago, and we could see more as the Fed continues to lower short rates and the supply of U.S. Treasuries steadily increases as U.S. government deficit spending continues to grow more debt. Now, I may have lost some of you in that jumbled word salad I just served up, so let me break that down a little more. I remember during the pandemic, when interest rates were super low, long Treasury bonds were yielding less than 2% at the time, someone said to me, "Michael, it must be really hard to sell bonds with interest rates so low." That person didn't realize it, but what they were saying was completely backwards. Let me turn it around 180 degrees and state it a little differently. Interest rates were low because people were buying up bonds to try to find protection from the uncertainties of the times. What I'm trying to get across here is that while everyone thinks interest rates are set by the Federal Reserve, they're actually set by the supply and demand for bonds. The more investors want bonds, then the more they drive down yields. And the more supply that comes to the market, the more it drives interest rates up. See, the Federal Reserve sets the overnight rate that banks borrow from each other. And the further and further you move away from that overnight maturity, the less and less impact the Fed has on that bond. Which bond is more impacted by the rate the Federal Reserve sets? The bond that comes due in 2 days or the bond that comes due in 2 years? Now what about the bond that comes due in 20 years? That rate is more driven by the demand for that maturity than it is by the rate set by the Fed for overnight borrowing. Thanks for letting me get a little nerdy on you there, but there are a lot of folks who have some confusion when it comes to why interest rates are where they are. Now, I know some of you have gotten this far and had this burning question in your mind, but Michael, what if rates go up instead of down? That's a great question, and one you should definitely be considering whenever you're investing in bonds. Remember, if you hold individual bonds to maturity, temporary price fluctuations don't matter. You'll receive all the promised interest payments and the full face value at maturity. You've got a predictable income stream regardless of market conditions. That 4.25% coupon from my example at the beginning doesn't change with interest rates. You will continue to receive that 4.25% from now until maturity. That being said, if you invested funds that you'll need in the near term, in the Treasury Strips I mentioned earlier, you could find yourself taking a pretty hefty loss. Long Treasury Strips are one of the most volatile bonds you can purchase. High risk, interest rate risk, not credit risk, means high reward or high losses, so buyer beware. Here's what you can do right now in the face of possible interest rate declines. 1. Review your current bond holdings. How will your bond respond to interest rate movement? And are you relying on the income stream that they're generating? 2. Consider extending maturities with high-quality treasuries. Treasury bonds will track the truest with the movements in interest rates, where if you bought a junk bond, it could see positive price action because of interest rate declines, but could actually go down in value because the underlying credit is having increased stress and is at higher risk of default. 3. Look into strips for maximum rate sensitivity. Decide whether you want to buy the peak of the strip yield curve or just go out as long as possible, factoring in how long you may have to wait if interest rates don't go your way. Start small and scale in gradually. 5. Watch call features and try to replace anything that is currently callable or callable in the next 2 or 3 years so you don't get a chunk of your principal back in a time where interest rates have declined a lot. For more insights on bond investing, check out my previous video on yield curve normalization. The link is on your screen now, along with a link to a video that YouTube thinks you would like. Remember to always consult with a qualified financial professional before making investment decisions. Your financial situation is unique, and what works for one investor might not work for another. Please see the description for the full disclaimer.